The holiday shopping season is upon us, but with signs of stretched household finances, what does the year ahead look like for the consumer sector? Joining us now to discuss is Jacky He, VP for Portfolio Research at TD Asset Management. Jacky, great to have you back on the program.
Thank you very much, Greg.
Great time to have you on to talk consumer stocks. Obviously, you know, the holidays for some of us getting a little too close if we haven't done our shopping yet. Let's talk about some of the stocks in the sector. They're doing quite well, others not so much. In a high level, what's the performance been like?
That's interesting. A lot of people, when it comes to consumer stock performing, people think about Amazon and Tesla. That's what we talked about previously. But that broad chart this time, as you can see, this time is not only about Amazon and Tesla. And in fact, on an equal-weighted basis, you see consumer stocks for the majority part of this year, they underperformed. But that trend started changing in September. When markets started positioning away from defense to offense, so discretionary stocks started outperforming. Do you recall what happened in September? Because U.S. started the rate cutting cycle, right? So the real economic impact, we know it will take time, but the sentiment impact is proved to be immediate. If you ask a U.S. consumer, they will say, okay, I'm not feeling much better about the current financial condition, but I do feel better about the future. And that trend even further improved post-election. That matters because future expectations are the stronger driver of consumer consumption behaviors than current expectations. That's why stocks are moving.
All right, so that's sentiment, very important in a consumer-driven economy. At the same time, the fundamentals, we've been through an earnings season. When you take a look at what the companies are actually handing in, how did that add up?
Yeah, it's interesting. We will talk about both consumer discretion sector and consumer staple sector. On a high level, it looks pretty strong, right? 70% of companies in both sectors beat expectations. But looking under the hood, you find the beat was primarily driven by lapping a high commodity cost. So the underlying demand remains subdued. If you look at the sector level, you see a discretionary sector look better than stable sector. But if we exclude Amazon and Tesla, you find discretionary sector did worse. That also makes sense because the macro pressure is still there, consumer feeling tight about their budget, very cautious about discretionary spending, right? And even if you look at the stable sector, where most products we consider as essential, we still see consumers have been pulling back on their spending across categories, except tobacco though. So that means to your question, overall the fundamentals are not bad, but it's probably not as good as people thought.
Now, obviously, when we were getting this earnings season and all the big retailers coming out in consumer stocks, people want to know about the quarter behind them, but this is the time of year when they want to hear company commentary, the quarter ahead, the all-important holiday season. How are things shaping up?
Yeah, people pay a lot of attention to holiday shoppings. People are nervous. The good news is Canadian shopping appears to be spending more this year than last year, just to adjust for inflation. The bad news is people seem to be compromising on volume. So don't be surprised if we don't get any Christmas gift this year, right? Because things are just getting too expensive. But if you look at the south of the border, things look more encouraging. Right? Consumers are broadly feeling wealthier. Whether you own stocks this year or you own Bitcoins, you benefit. Right? And also those big retailers, they extended the promotional periods by starting earlier and finishing later. That also allows the deal to flow through longer. What's more interesting this year is consumers started using their phone more, started buying stuffs online more than visiting store. So that means deal still matters. That means business with stronger digital capabilities are better positioned in this holiday season.
Yeah, my wife asked me what I wanted for Christmas, and I said nothing. I'm full on like dad years now. Just want some time off with family. She does not like that answer. The consumer stocks probably don't like that answer either. Let's talk a bit about brands. What makes a strong brand, right? Because it seemed to me that for this earnings season, there were, even though there's a lot of caution out there, some brands can still sort of earn their way. How do you monitor that?
Yeah, great question. There are many brands out there, like hundreds of thousands globally, right? So it's clearly very crowded space. So for a brand to grow, they have to grow by eating other people's cake. So to do that, a good brand needs to deliver the right products with the right messaging through the right channel, right? And a great brand have to develop stronger emotional connection with consumers. And the most effective way to do so is really through social media. right? Where more and more consumers are being influenced every day to make purchase decisions. And that's also where we like to focus on how the brands engage with customers digitally. Maybe I'll give you some examples. Think about Ralph Lauren in the discretionary sector or Colgate in the staple sector. Both of them doubled down their marketing spend over the past couple of years. That has been quite successful. And more importantly, they shifted their marketing dollars away from the traditional TV or magazine to really social media, where they are getting much higher investment returns.
Yeah, where the kids are. That's where my kids are. They don't watch traditional TV at all. So a lot of interesting things happening this year, a lot of trends playing out.
Yeah.
Where do you see the risks for next year for the consumer stocks?
Yeah, the number one thing that comes to mind, nothing surprise, is tariff. Right? Under the new administration, I think tariff will be real. Interestingly, a lot of market participants do anticipate like 10% higher tariff on China, the Chinese good. But few people are expecting the additional tariffs on Canada. Many people believe that's a negotiation tool for the border control, which do make sense, but it can be an area of surprise in the new year. And remember, even if Canada avoid this tariff completely this time, USMCA is still scheduled to be renewed in 2026. So that means the tariff overhang will unlikely to go away anytime soon. The other risk I'd monitor is on margins. This year, a lot of companies benefited from lapping high commodity cost from last year. Going forward, we see a lot of commodities started bottoming out, with some even reaccelerating. If you think about cocoa or coffee, right? And also on freight, we could also see some upside pressure because businesses started pulling forward their inventory shipments just to avoid tariffs. If more businesses keep doing this ahead of their annual renegotiation time in spring, we could end up with higher freight costs. All that said is the company-specific cost-saving initiatives will be more important next year than this year.
Right, Jacky, we put all of that together as we head into 2025. We think about positioning in terms of the consumer space. What should be top of mind?
Yeah, there are a lot of broad themes since the pandemic, right? And it's fair to say a lot of those broad themes, like gross margin recovery, they are in the rear view mirror. So going forward, consumers are recovering, but not strong enough to lift all the boats. So that means 2025 will be a more normal year and be a bigger year for stock selecting. Within the consumer space, I think the U.S. consumers are better positioned than Canadian consumers just because they have lower debt, higher net worth, and the more resilient labor market. And within the sectors, I think that this discretionary sector is better positioned and the stable sector. That's because consumers' discretionary cash flows are projected to be better next year. Think about after lower interest expenses, lower inflation, they will end up more budget in their wallet. So from stock perspective, I think focus on two things. One is the companies with really strong market share momentum. We talk about that. And also the business that tied to secular tailwinds, but that are currently masked by cyclical headwinds. We can see more opportunities there. So one area I like to highlight is the apparel and the footwear industry. That has been more discretionary overall, and people have been pushing back on their spending there. Retailers have also been very cautious there. They keep inventory pretty low. So if the pent-up demand started to recover as the discretionary cash flow improves, we could see that's one of the first areas to recover in the new year.